Welcome back to the Deep Dive. Today we're getting into Hedera Hashgraph, HBAR. It's this distributed ledger tech that's really tried to stand apart from the usual crypto chaos. They're aiming for stable industrial grade uses.
That's the pitch, definitely. And our sources are pretty interesting today. We've got the original HBAR economics paper from June 2020, some deep technical dives, and then market commentary right up to this month, October 2025. So the mission really is to see past the hype. What is this tech fundamentally? Why are big companies actually using it? And importantly, how does today's market reality stack up against their original plan?
Right. And the big question with any DLT always comes back to that trilemma. Security, decentralization, speed. You usually only get two. Hedera claims they nail all three. So if it's not blockchain, what's actually under the hood?
Yeah, they ditched the chain concept. Hedera uses the Hashgraph consensus algorithm, and the structure is a directed acyclic graph, a DAC. The way it works is often described using this idea of gossip about gossip.
Gossip about gossip. Okay. Sounds intriguing. Yeah. Can you break that down? How does that make it faster than a typical blockchain?
Sure. Imagine a standard blockchain is like one person speaking at a time in a meeting, right? Everyone waits for them to finish the block, then agree. Hashgraph is more like everyone quickly telling two random neighbors what they just heard. Gossip.
So it spreads information exponentially faster, not linearly.
Exactly. It's this incredibly rapid asynchronous sharing. That's how they reach consensus so quickly. And the math behind it proves it achieves the highest security standard, which is asynchronous Byzantine fault tolerance, or aBFT.
aBFT. That means it's trustworthy, even if some actors are malicious,
right?
Up to a third.
Precisely. Even if a third of the nodes are down or trying to cheat, the network still guarantees the final order of transactions. That's huge for enterprise.
Okay, so high security, super fast. What are the actual performance numbers, like speed and cost?
We're talking over 10,000 transactions per second, easily. And finality, knowing your transaction is 100% confirmed, takes just a few seconds. But for businesses, the real hook is pairing that speed with really low predictable fees. The target is about 0.00011 per transaction, 1/100th of a cent.
Wow. Okay, $0.00001. That predictability is a world away from, say, Ethereum gas fees going wild. But if it's that cheap, what stops someone just spamming the network with millions of tiny transactions?
That's a fair question. The predictability is key, but the fee structure isn't zero, and it's nuanced. For example, there's one transaction type, consensus submit message, which apps use quite a bit for heavy data. That fee is actually set to go up slightly to about 0.00008 starting January 2026. So there is a cost, just very low and crucially stable and scheduled by the council.
Got it. And there's also the green angle, right? Sustainability.
Absolutely. It's designed to be incredibly energy efficient, even aiming for carbon negative. Compared to proof of work, it's negligible. For big companies with ESG goals, that's a major plus.
Okay, let's switch gears to the token itself, HBAR. If Hedera is all about enterprise, not speculation, what does HBAR actually do? What are its core functions?
It really has two critical jobs. First, it's the fuel. The network fuel. You use HBARs to pay for any service, sending crypto, running smart contracts, storing files, using the Hedera consensus service. Everything costs a tiny bit of HBAR.
And those transaction fees you mentioned, they're broken down.
Yeah, transparency is key there. Each fee has three parts. A node fee that pays the node processing your transaction, a network fee, which goes to the Hedera treasury for overall costs and growth, and a service fee, based on how complex your specific transaction is. It's like getting an itemized bill, which helps with that predictability.
Okay, fuel makes sense. What's the second, maybe more crucial role?
Network security. That's the big one. HBAR protects the network using a proof-of-stake system, but it's coin-weighted. See, in permissionless networks, the big danger is a Sybil attack, someone creating tons of fake identities, fake nodes, to overwhelm the consensus vote.
Right, the digital army trying to cheat the system.
Exactly. Hedera stops that by tying voting power directly to how much HBAR you stake. Strictly one HBAR, one vote. So to mess things up, to force through a bad transaction, an attacker would need to get their hands on and stake 1/3, 13, of all the HBAR in existence. The whole economic model is designed to make acquiring that 13 stake astronomically expensive.
So how do regular people holding HBAR help defend the network if they aren't running, server farms?
Through something called proxy staking. You don't need to run a node yourself. You can delegate the voting weight of your HBAR to an active node run by someone else. You contribute to security, earn a small reward, expect it to be pretty minimal, mind you. But here's the key difference from a lot of proof-of-stake systems.
What's that?
Your staked HBAR remains completely liquid. It's still in your account under your control. There's no lockup period. You can spend it or move it instantly.
No lockup. That's a huge deal, especially for institutions that need liquidity. Okay, let's talk about governance. This seems very different from typical crypto projects.
It is, and it's probably Hedera's biggest draw for traditional businesses. The network is governed by the Hedera Governing Council. This is a council of up to 39 massive global organizations, like household names in banking, tech, aviation, law.
So less like a decentralized collective and more like a board of directors for the internet.
Sort of, yeah. But crucially, it's decentralized among these major players. They have equal votes on things like setting fees, managing the treasury, deciding on software updates, and they're term-limited 2 consecutive 3-year terms maximum to prevent anyone getting too entrenched. Except Swirlds, the company that invented the tech.
That provides stability, especially early on. But the goal is eventually full decentralization, right? Yep. Allowing anyone to run a node, not just the council.
Yes, that's the roadmap. But that transition to permissionless nodes is tied directly to that 13 security threshold we talked about. The plan is, or was, to only open it up once HBAR coins are distributed widely enough that it becomes practically impossible, or at least prohibitively expensive, for any single entity to buy up that critical 1/3. Security first.
Okay, stability first. Now, let's get concrete. Who is actually using this? Give us some real-world examples.
Okay, so in finance, you've got Shinhan Bank in Korea looking at stablecoins for cross-border payments. Think cheaper, faster international money transfers. That's a huge pain point solved. Then there's Abrun, the big global investment firm.
Yeah, I know them. What are they doing?
They're tokenizing money market funds on Hedera. Basically, making traditional investments easier to access, trade, and potentially own fractionally. And in just general enterprise IT, look at ServiceNow. They're huge in workflow automation.
Right, almost every big company uses them for something.
Exactly. They're integrating Hedera's DLT to bring more trust and transparency to processes that involve multiple companies sharing data, like proving data integrity in a shared supply chain system. We also see IBM involved, Chainlink integration for real-world data feeds. The developer activity is genuinely high, especially around tokenizing real-world assets.
Okay, the adoption seems real. Which brings us to the economics and, well, the current market situation as of October 2025. Let's talk supply.
Right, so Hedera has a fixed supply, absolutely fixed at 50 billion HBAR. They were all created or minted right at the start in 2018. They sit in the Hedera treasury, and moving them requires a majority signature from the governing council members. Very controlled.
And the original plan from that 2020 paper was to release these coins really slowly, right? To match adoption, keep things stable, and avoid speculation messing with the network security.
That was absolutely the strategy laid out. The 2020 paper projected that by the end of this year, 2025, maybe less than 31% of that 50 billion supply would be circulating. Slow and steady, but here's where our recent sources show a massive shift. As of October 2025, the market data indicates the circulating supply is actually around 42.4 billion HBAR.
Wait, 42.4 billion out of 50, that's what, nearly 85%?
44.8%, yeah.
Hold on. That's way ahead of the original schedule. We just spent time talking about how critical it is to make acquiring 13 of the supply super expensive for security. If they've released almost 85% already, doesn't that drastically lower the cost to reach that 13 attack threshold? Doesn't that kind of undermine the core stability promise they made to all those big companies? This seems like a major conflict with the founding economics.
It is the central tension right now. The original documents definitely flagged rapid distribution as a potential risk factor for that exact reason. The Council's rationale for accelerating the release seems to be about fueling faster than expected ecosystem growth, especially seeing adoption take off in places like Asia. But you're absolutely right. It puts enormous pressure on the network security model. It makes that transition to permissionless nodes and widespread staking much more urgent, to decentralize control before anyone could theoretically accumulate that 13 state more cheaply than planned.
That completely changes the risk calculation for users and investors. So with that backdrop, what are the immediate headwinds HBAR is facing in the market right now?
Well, despite the real utility and all those developers building we saw over 200 GitHub commits just in the last month. The price and market sentiment are facing roadblocks. A big one is regulatory uncertainty. The SEC, for instance, has delayed decisions on spot HBAR ETF applications. Canary's filing got pushed back again, now to November 2025. That delay caps the potential for large-scale institutional money to flow in, money that could help absorb that large circulating supply.
So the tech is working, companies are adopting, but the financial infrastructure, the regulatory green light for big capital, isn't there yet.
Exactly. And it creates weird signals. Like looking at derivatives, the amount of HBAR flowing into exchanges has dropped significantly, like 76% since mid-October. Usually less selling pressure is good. But at the same time, about 76% of the open interest in HBAR futures is short positions, betting the price will go down. That creates a risk of high volatility if there's a sudden price move and those shorts get squeezed. So you have this battle, growing real-world use bumping up against market caution, regulatory delays, and the economic reality of that accelerated coin release.
Okay, let's try and synthesize this for you. Hedera clearly offers something different. It's high speed, highly secure, thanks to that aBFT, and laser-focused on enterprise needs for stability and predictable costs. It's backed by some huge corporate names via the governing council. But, and this is a big but, the strategy around coin distribution seems to have shifted dramatically, releasing far more HBR much faster than planned. This introduces a new dynamic and increases the pressure to fully decentralize quickly to maintain that promised security threshold.
Yeah, the network was built for long-term stability for big players, but managing the tension between that security model, which relies on scarcity, and the current market reality of abundant supply. That's the tightrope they're walking now.
Which leaves us with the final thought for you to chew on. Hedera's main selling point has always been its rock-solid stability for corporations. But what happens when it does fully decentralize, letting anyone run a node? And that carefully engineered stability meets the wild, unpredictable, often speculative forces of the open crypto market. Can the tech guarantee hold firm against market dynamics? Something to think about. We'll see you next time on The Deep Dive.